Hello, my name is Steve Bigelow with the Candlestick Forum. We're doing up this little training to show people that are just beginning to look at candlestick analysis, what the common sense aspects are of candlesticks. I've been doing candlestick analysis now for over 3 decades, and the one compelling factor is that it all makes sense. Everything built into a candlestick chart is just common sense put into a graphic depiction. There's two major aspects to candlestick analysis. They were developed by the Japanese rice traders over 400 years. So what they produce is that not only is recognizing the high probability reversal signals that show a change of investor sentiment, which are very, once you learn those, they're like the ABCs of your candlestick analysis. The Japanese rice traders also went further to showing what the logic was that created those signals. Once you have those two elements, now you have the same grasp of what moves prices as a seasoned trader that may have been trading for 40 or 50 years. Now, there's one basic assumption for candlestick analysis. Prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. So the Japanese rice traders produced some very easy observations. They could graphically show where most people buy. They buy exuberantly at the top. They could also show where most people sell. They panic sell at the bottom. So the basis of candlestick formations is the information that is built into any time frame and the candlestick signals they produce. A candlestick signal is produced by when it opens here and closes above where it opens, it creates a bullish candle. On some charts, it is a green candle versus a red candle. Other charts, it might be a white candle versus a black candle. But the formation is completed with, here is the range, this is the low of the time frame. Now, during this presentation, we're going to use a time frame as daily charts or a daily time frame. But candlestick analysis is the graphic depiction of everybody buying and selling during a specific time frame. It works equally well on a 1-minute chart as it does on a monthly chart. When it closes above where it opens, a bullish candle. There's your high for the day. Conversely, if it opens here and closes here, below where it opened, it's going to create a bearish candle. Again, the wicks or the shadows are what the complete range was during the day. This information is very vital because it tells you what's going on in investor sentiment, and it creates signals that the Japanese rice traders identify as being reversal signals of investor sentiment. Now, that doesn't necessarily mean that a red candle is bearish or it's down. You can have a situation where they open up here and close here, but as you can see, it was up dramatically during the day. Or you have a green candle or bullish candle, but notice that it closed down during the day. So that is valuable information for the Japanese rice trader, for the candlestick investor, because it tells you that there's been a change of investor sentiment. So there is very simple logic from the Japanese rice trader's point of view. If you see a candlestick buy signal in the oversold area, the probabilities are pretty strong that an uptrend is about ready to start. Or on the other side of the coin, if you see a candlestick sell signal in the overbought conditions, the probabilities are pretty strong. A downtrend is about ready to start. Now, we use stochastics to show where we are as far as the trends. And it's a measure of overbought and oversold conditions. If you see stochastics are below 20 on the stochastics chart, you're in the oversold area. If you see stochastics in above 80, you're in the overbought area. Now, the Japanese rice traders produced or recognized reversal signals. We've narrowed it down over the last 30 some odd years to 12 high probability candlestick signals. Now, in the Japanese universe, there's 50 or 60 signals. However, most of those signals don't occur often enough to spend mental time and energy trying to learn them. We recommend just learning the 12 major signals, because not only are they going to occur with great frequency on any time frame, but they're the ones that are going to produce the most powerful returns. And through the years, we have developed or identified technical indicators that dramatically improve the probabilities of being in a correct trade. This is the T line, the black line right here. It's the 8 exponential moving average. We call it the T line, short for trigger line or trade line, because there's a very simple element to the T line. If you see a candlestick buy signal and a close above the T line, you can stay long until you see a candlestick sell signal and a close back below the T line. Now, on our charts, we try to keep it very simple. Notice our stochastics. We use stochastics of 12, 3, 3. And that's because most of the trades that I do are swing trades. They last anywhere from 2 to 10 trading days. And this was a very simple process to find out whether or what is the most effective stochastics. And that was just spending an evening seeing where do the buy signals occur in the oversold area and where do sell signals occur in the overbought area. The other moving averages we have on our charts is the 50-day simple moving average and the 200-day simple moving average. The reason those are on our charts is because every major money manager around the world uses those two moving averages to make their decisions about their portfolio. We don't have them on here to make our decisions. We have them on here to see what the candlestick signals are telling us everybody else's decisions are at those levels. So very simple T-line rule. You see a candlestick buy signal, you can stay long until you see a candlestick sell signal and a close below the T-line. Conversely, if you see candlestick sell signals and a close below the T-line, you can stay short until you see a candlestick buy signal and a close back up above the T-line. So we'll start with the most recognized candlestick signal. It's the Doji. A Doji represents indecision between the bulls and the bears. If there's a small trading range during the day and it closes where it opens, creating kind of a cross, that's called a Doji star. If the trading range is big during the day and closes about the same level, it's called a long-legged Doji. The Japanese rice traders explain that if it opens at the top of the range, trades down, and then closes back at the top of the range, it's called a dragonfly Doji because it looks like a dragonfly. And the gravestone Doji is described as the warriors coming out of camp, going into battle, and at the end of the day they're beaten back into camp, leaving their dead all over the field, thus the gravestone Doji. You also have a spinning top, which is almost a Doji. It just has a little bit bigger body. It looks like a spinning top, but it represents the same thing. indecision between the bulls and the bears. So the Japanese rice traders tell us if you see a doji in the oversold area at the bottom of a trend, if they open positive and trade positive the next day, the probabilities are pretty strong you've now had a reversal. Or on the other side, if you see a doji at the top in the overbought condition, if they start trading it lower the next day, it's going to continue down. This is what we call the Doji rule. The Doji rule is very simple. The price will usually move in the direction of how they open after a doji. The next major signal is called the bullish engulfing signal. Very visually easy to recognize. It opens below the previous day's close and closes above the previous day's open. The candle body completely engulfs the candle body of the previous day. Not necessarily the shadows or the wicks, just the body. This illustrates there's been a change of investor sentiment, especially in the oversold area, one of your major bullish signals. The bearish signal is where a bearish engulfing signal is where they open above the previous day's close and close below the previous day's open. This candle completely engulfing this candle right here. That is when you can start looking for selling to the downside. These are just high probability observations that the Japanese rice traders have illustrated for us for years. They also have simple little rules. The bigger the signal, the more compelling there's been a change of investor sentiment. Another major reversal signal is the hammer signal. Hammer signal has the only formula that you have to know in candlestick analysis, and that's the number 2. A hammer signal at the bottom of a downtrend, the tail or the shadow is 2 times greater than the body. It doesn't matter whether the body is a bullish candle or a bullish formation or a bearish formation. The Japanese rice traders explain it as the bears have hammered out the bottom and the bulls have stepped back in. The same formation at the top of a trend is called a hanging man signal. The Japanese rice traders explain it as there's his head, there's his legs dangling down, and it's a precursor to a change of investor sentiment. If it opens or prices open lower the next day, the downtrend has started. The piercing signal has 2 parameters. 1, it opens below the previous day's trading, not just the body, but any of the trading during the previous day. And then the next parameter is that it has to close more than halfway up the previous dark candle. The deeper they open this and bring it back up, the more evidence there is that the sellers were stopped and the bulls started back in. The opposite of the piercing signal is the dark cloud. It opens above any of the previous day's trading and closes more than halfway down this candle. The Japanese rice traders explain it as everything's sunny, everything's sunny, everything's sunny, and then there's your dark cloud, which tells you the bears have started to take control. Another major reversal signal is the shooting star. Again, the tail is 2 times greater than the body at the top of a trend. It looks like a shooting star coming out of the sky. The Japanese rice traders make it very simple to analyze. If you see this shooting star, especially up toward the overbought area, and it opens lower the next day, your downtrend is likely to have started. Now, the shooting star formation at the bottom of a trend is called an inverted hammer. Again, the tail 2 times greater than the body. the psychology or the explanation of this is the bears are happy, the bears are happy. And then down here, the bears are nervous because the bulls have stepped in, but they're relieved at the end of the trading time frame because it closed near the lower end of the range. But they were nervous. If it opens positive the next day, the bears say, shoot, the bulls are back again, let me get out of this trade, and that starts this uptrend. Now, I point this out. This is, again, only from observations over the last 30 some odd years of using candlestick analysis, my own observations, that if you see a positive open after an inverted hammer, the probabilities are 95% or greater that you're going to be in an uptrend. And another element that is applied to candlestick analysis is if we know that these are high probability reversals, we also know where our stops should be. A lot of, you always hear the terms or the sage advice that you want to cut your losses short and let your profits run. But nobody ever tells you how to cut your losses short and let your profits run. The analysis of candlestick signals makes that very simple. We know what reversal signals should be doing, and we know the levels where they shouldn't be trading if that trade didn't work. The bullish Harami in Japanese means pregnant woman. There's her body and there's her little belly sticking out, and it essentially tells you that the selling has stopped. So if you're in a downtrend and you're in the oversold area and you see a bullish Harami, if they open up positive the next day, consider your uptrend ready to start. The opposite of a bullish Harami is the bearish Harami. These are known in Western terminology as inside days. It opens below the previous day's close and closes above the previous day's open, telling you the buying has stopped. So when you see that lower open and then they open it lower the next day, that tells you the buying has stopped, your downtrend has started. The morning star signal is a 3-day reversal. A big bearish candle at the bottom of a downtrend, a day of indecision, and then the third day closes more than halfway up this candle. Again, that number 2 formula. This is a morning star signal, or the Japanese rice traders explain it, that's the beginning of a sunny day or your start of an uptrend. The opposite is called the evening star signal. A big up day at the top of the trend, a day of indecision, and the third day closes below the halfway point of this candle. This tells you the selling or the buying has stopped. Look for your downtrends to occur. The kicker signal is your strongest individual candlestick signal. If you're in a downtrend and it opens here on the last day, closes here, then the next day they open it at or above the previous day's open and goes in the opposite direction, the investor sentiment has been kicked in a new direction. Same scenario if you're in an uptrend and they have a bullish day, the next day they gap it down below the previous day's open and trade lower. The bears have kicked the direction into a downtrend. So anytime you see that kicker signal and they open above and even gap it up above the previous day's open and trade positive, that tells you there's been a major change of investor sentiment. And the expectation of that signal is a very strong uptrend. If you're in an uptrend and they're gapping down, just think of the logic built into the candlestick signal. If you're in an uptrend, they shouldn't be gapping it down and going the opposite direction. If you're long and you know what a bearish kicker signal is illustrating, you close it immediately on the open. If they have a green candle and they gap it down, these are the expectations. That information right there tells you there's strong bearish sentiment starting to take control. So those are basically your 12 major signals. Now the advantage of using the signals is they enhance candlestick patterns, which is also the element of investor sentiment. The Japanese rice traders use candlestick signals and patterns because of one very effective result. Investor sentiment works the same way time after time. If we didn't, we wouldn't be looking at their signals and patterns hundreds of years later. A major candlestick pattern is what we call a fry pan bottom. Indecisive trading and then a strong move to the upside, and these have expected results. Usually going to produce very strong price moves. So when we can see a strong signal right at the breakout level, remember we're buying the candlestick signals when they're in the oversold area. We're buying candlestick pattern breakouts when the stochastics are telling you you're already in an overbought area. But the results are high probability, strong price trades. So basically candlestick analysis is based upon candlestick logic. Again, prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. And the Japanese rice traders use just simple logic. Again, if you see candlestick buy signals in the oversold area, that's a high probability you're going to be in an uptrend. If you see candlestick sell signals in the overbought area, the probabilities are that your downtrend is about ready to start. So that's as simple or as easy to recognize what directions prices are moving. I've written 3 books that are easy to read. There's no fluff in them. If you want everything succinct and right to the point, that's how I've written these, because when I was investing, I wanted to tell me or have people tell me what works, not all the fluffy stuff that goes around it. So join us at the candlestickforum.com. We have chat rooms open every day where people are learning and showing very high profit candlestick trades, and we do training for members every Monday night and every Thursday night, as well as the chat rooms being open all day long. And then usually on Tuesday and Wednesday nights we do special sessions on how to use candlestick analysis effectively for your own training and your own trading, like stop losses or scanning techniques to find the best signals and patterns, or improving your entry and exit strategies. Things that are all common sense elements that are built into candlestick analysis. That'll be it. Hopefully we'll see you in the chat rooms.